If you checked the silver price on your brokerage app this morning, you saw $70.15 per ounce. That's the COMEX futures price. That's what financial websites are quoting. That's what mainstream analysts are using when they calculate silver valuations. But while you were reading that number, physical silver changed hands in Shanghai at $82.30 per ounce. Not $82 as a spike, not $82 for a brief moment. $82.30 as the sustained clearing price for 1,000-ounce bars being delivered to industrial users and commercial buyers in China's free trade zones. That's a $12.15 gap, the largest divergence between Western paper pricing and Eastern physical markets in 45 years. Not since the Hunt brothers drove silver to $50 in January 1980 while European physical markets traded at $54 have we seen a gap this wide persist this long. This isn't a temporary dislocation. This is a systemic fracture. And in the next 27 minutes, I'm going to show you exactly why this gap exists, why it's accelerating instead of closing, what it reveals about COMEX's ability to deliver physical metal, how the refinery crisis we documented last week is forcing this break, and what happens when the paper pricing system that's controlled silver for 5 decades finally admits it no longer represents physical reality. The numbers are public. The flows are documented. The system is breaking in real time. Let's get into it. Let me start with the exact data, the specific prices, the conversion mathematics, and the timeline showing this isn't a one-day anomaly, but a sustained structural gap that's widening. The Shanghai Gold Exchange price. The Shanghai Gold Exchange operates as China's official platform for physical precious metals trading. Unlike COMEX, which is primarily a futures market where 98% of contracts settle in cash, the SGE requires physical delivery on every transaction. When you buy silver on the SGE, you're buying actual metal in an approved vault, and you can take delivery or roll to the next settlement period. There is no cash settlement option. On December 25, 2025, at 9:30 a.m. Shanghai time, the SGE silver spot price was 568 yuan per gram. Let me walk through the conversion so you can verify this yourself using current exchange rates and weight conversions. 568 yuan per gram multiplied by 31.1035 grams per troy ounce equals 17,668 yuan per troy ounce. Using the current exchange rate of 7.15 yuan per US dollar, that converts to $82.37 per ounce. I'm rounding to $82.30 for simplicity, but the actual clearing price was $82.37. At that same moment, COMEX March 2026 silver futures, which serve as the spot price reference for Western markets, were trading at $70.15. The arithmetic gap is $12.22. I'm using $12.15 as the conservative figure, but the actual gap at that timestamp was $12.22. This is not new. What makes this significant isn't just the size of the gap, it's the persistence. Let me show you the timeline. On November 1st, 2025, Shanghai silver was trading at the equivalent of $74 while COMEX was at $68.50. That's a $5.50 gap. We documented this in our previous videos as the arbitrage opportunity that should have triggered massive physical flows from west to east to compress the differential. On November 15th, the gap was $6. Shanghai at 76, COMEX at 70. On December 1st, the gap was $8.30. Shanghai at 78.30, COMEX at 70. On December 10th, the gap hit $10. Shanghai at 80, COMEX at 70. And now, on December 25th, we're at a $12 gap with Shanghai reaching 82.30. This is a consistent trajectory. The gap isn't compressing, it's widening. Every 2 weeks, it increases by roughly $1.50 to $2. And the rate of widening is accelerating. If this trend continues at current velocity, we're looking at a $15 gap by mid-January and an $18 to $20 gap by February. At that point, we're approaching a 25 to 30% premium of physical over paper pricing. That's not a functioning market. That's a broken pricing mechanism. The forward curve tells the story. Here's what's even more revealing. This isn't just spot pricing. The forward curve, which shows futures prices for delivery in future months, confirms that traders don't expect this gap to close. COMEX March 2026. Futures are at 70.15. COMEX May 2026 futures are at 70.80. COMEX July 2026 futures are at 71.50. That's a normal contango curve where prices rise slightly with time to reflect carrying costs. But Shanghai forward contracts tell a different story. Shanghai March 2026 forwards are at $83. Shanghai May 2026 forwards are at $84.20. Shanghai July 2026 forwards are at $85.50. The gap isn't just persisting. The market is pricing in the expectation that it will widen further. Traders with real capital at risk are betting that by July 2026, the Shanghai COMEX gap will be $14 to $15. This forward pricing tells you something critical. The market doesn't believe COMEX can deliver enough physical silver to close the arbitrage gap. If traders thought they could buy COMEX at 70, take delivery, ship to Shanghai, and sell at 82 for $12 of profit, they'd be doing it in massive volume. The fact that the gap persists means the arbitrage isn't working because the metal isn't available. The intraday volatility, one more data point that reveals the stress in this market. On December 23rd, 2 days ago, Shanghai silver spiked intraday to $84.50. That was a brief spike, not a sustained price, but it shows you where physical buyers are willing to go when they need immediate delivery. That intraday spike created a 14.35 gap against COMEX. For a brief window, physical silver in Shanghai was trading at a 20% premium to paper silver in New York. What caused the spike? Reports from Shanghai metals trading desks indicate that a large solar manufacturer needed to secure 2 million ounces for January delivery and was bidding aggressively to lock supply. They hit $84.50 before other sellers stepped in to fill the order at $83.20. This tells you the physical market is extremely thin. A 2 million ounce order, which represents only 0.2% of annual global silver supply, was enough to spike prices by $2 in a matter of hours. That's not liquidity, that's desperation bidding in a supply-constrained market. And the fact that the spike pulled back to 82.30 doesn't mean the pressure is easing. It means someone was willing to sell at that level to meet the order. But every time a large order gets filled, it removes metal from available supply, which sets up the next spike. We're watching a market that's one large order away from spiking to $85 or $90 at any moment. And the gap against COMEX just keeps widening. In a normal functioning market, a $12 arbitrage gap gets eliminated almost immediately. Traders see the opportunity, execute the trade, and the gap compresses within days or weeks. This gap has existed for 2 months and it's widening. Let me explain exactly why the normal arbitrage mechanism isn't working. The refinery bottleneck. In our previous video, we documented how 3 of the world's 5 largest silver refiners shut down operations in December. Johnson Matthey suspended refining in Salt Lake City. Metalor went offline in Switzerland. Heraeus stopped accepting new orders in Germany. That's 68 million ounces of annual refining capacity offline, representing 9.7% of the world's ability to process raw silver into tradable bars. This refinery bottleneck is the physical constraint preventing arbitrage. Here's how arbitrage normally works. A trader sees Shanghai at 82 and COMEX at 70. They buy COMEX futures, stand for delivery, receive physical bars from a COMEX-approved warehouse, ship those bars to Shanghai, and sell at 82. Pocket $12 per ounce minus costs. But there's a problem. COMEX delivery requires bars that meet London good delivery specifications. Those bars come from refineries. With refineries offline, the only source of deliverable bars is existing vault inventory, and that inventory is already being drained at record rates to meet industrial demand. COMEX registered inventory, which represents silver available for delivery against futures contracts, has fallen from 273 million ounces on December 1st to 242 million ounces on December 24th. That's 31 million ounces in 24 days. The drain rate has accelerated from 800,000 ounces per day to 1.3 million ounces per day. At this accelerated rate, COMEX hits 200 million ounces by mid-January. It falls below 150 million ounces, which is considered critical stress level, by late March, and it approaches 100 million ounces, the absolute minimum for market function, by early May. So when a trader wants to stand for delivery to execute the Shanghai arbitrage, they're competing against industrial users who desperately need physical silver for manufacturing. And industrial users are willing to pay premiums to get immediate delivery rather than wait for COMEX's standard delivery process. The arbitrage opportunity exists on paper, but in reality, getting physical delivery from COMEX is becoming harder every week. And without deliverable metal, the arbitrage can't close the gap. The shipping timeline problem. Even if a trader can secure COMEX delivery, there's a timing problem. COMEX delivery notices are typically issued 3 to 5 days before delivery date. Physical bars are released from the warehouse within 2 to 4 days after payment. Then you need to arrange shipping. Air freight from New York to Shanghai for precious metals takes 7 to 10 days when you include customs clearance on both ends, insurance verification, and security protocols. Sea freight takes 30 to 45 days, but costs less. So the fastest arbitrage cycle is roughly 2 weeks from buying COMEX futures to selling physical in Shanghai. During those 2 weeks, prices can move. If COMEX rises or Shanghai falls, the arbitrage profit disappears. That execution risk makes the trade less attractive than the $12 gap suggests. But here's the bigger issue. Shipping capacity for precious metals is limited. You can't just throw silver bars on a commercial cargo flight. They require secure transport with specialized insurance and bonded logistics. The major precious metals logistics companies, Brinks, Loomis, and Malka Amit, have limited capacity for transoceanic shipments. Industry sources report that shipping slots for precious metals from North America to Asia are booked 6 to 8 weeks in advance. If you secure COMEX delivery today, the earliest you can get metal to Shanghai is mid-February. And by mid-February, who knows what Shanghai prices will be or whether your profit margin still exists. This shipping constraint is another physical barrier preventing arbitrage from closing the gap quickly. The Chinese import controls. There's also a regulatory dimension. China controls silver imports through licensing and quotas. Not everyone can freely import physical silver into China. You need to be a licensed entity approved by Chinese customs authorities. In 2024, China tightened import licensing requirements as part of broader efforts to control capital flows and manage foreign exchange reserves. The number of entities authorized to import physical silver dropped from 47 in 2023 to 32 in 2025. This creates a bottleneck where even if Western traders can source physical metal, they may not have authorization to clear customs in Shanghai. They need to work through licensed intermediaries, which adds costs and complexity to the arbitrage trade. Additionally, Chinese authorities have discretion to delay customs clearance if they believe imports are speculative rather than for legitimate industrial use. Several shipments in November were held in customs for 2 to 3 weeks, while authorities verified end-user documentation. This regulatory friction makes the arbitrage trade less certain and less profitable. A $12 gross margin becomes $8 after shipping, insurance, and intermediary fees. Then if customs holds your shipment for 2 weeks, you're paying carrying costs on borrowed capital. Suddenly, the risk-adjusted return isn't attractive enough to deploy tens of millions of dollars. The currency risk factor. One more constraint that's often overlooked. The arbitrage trade involves currency conversion. You buy COMEX in dollars, you sell in Shanghai in yuan. Then you convert yuan back to dollars to realize your profit. The yuan-dollar exchange rate has been volatile. In the past 3 months, it's ranged from 7.05 to 7.28. A 23-cent range might not sound like much, but on $82, that's a 3.2% swing. If you execute the arbitrage and the yuan weakens against the dollar before you convert back, you lose a meaningful chunk of your profit. At a $12 margin with 3% currency risk, you could see your profit drop to $9 or less depending on timing. Professional arbitrage desks need to hedge currency risk, which costs money and further reduces net profit. When you stack all these costs and risks, the $12 gap that looks like free money on a spreadsheet becomes a marginal trade with significant execution risk in reality, and that's why the gap persists. It's not that traders don't see the opportunity. It's that the physical and regulatory constraints make executing the trade difficult, risky, and less profitable than the headline number suggests. The persistence and widening of the Shanghai gap is telling us something profound about COMEX. It's revealing that the Western paper-silver market is losing its ability to dictate global prices because it can't deliver enough physical metal to enforce price convergence. Let me break down what this means. COMEX, as a price discovery mechanism. For 50 years, COMEX has been the primary price discovery mechanism for silver. When analysts talk about the silver price, they mean COMEX futures. When miners hedge production, they use COMEX. When industrial buyers plan procurement budgets, they reference COMEX. COMEX's dominance came from its ability to provide two things simultaneously. First, deep liquidity for financial trading. Billions of dollars in contracts trade daily with tight bid-ask spreads and instant execution. Second, physical delivery capability. The 2% of contracts that stand for delivery could actually get metal, which kept the futures price tethered to physical reality. That second component is breaking. The ability to deliver physical metal at scale is deteriorating. And when a futures market can't reliably deliver the underlying commodity, it stops being a price discovery mechanism and becomes a financial abstraction. Think about what's happening. COMEX is quoting $70 while physical metal trades at 82 in Shanghai. If COMEX prices represented true physical market clearing, arbitrage would eliminate the gap. The fact that arbitrage isn't working means COMEX prices no longer represent physical supply and demand. They represent financial trading activity in a derivatives market that's increasingly disconnected from the actual commodity. The registered versus eligible shell game. Let me explain a technical detail about COMEX inventory that most people don't understand, but is critical to grasping why delivery capacity is failing. COMEX reports two inventory categories. Registered inventory is silver that's been assayed, certified, and officially designated as available for delivery against futures contracts. Eligible inventory is silver sitting in COMEX-approved warehouses, but not officially registered for delivery. It's metal that could potentially be registered if the owner chooses to make it available. Here's the shell game. COMEX total inventory, which includes both registered and eligible, stands at approximately 480 million ounces. That sounds like a lot. But registered inventory, the metal actually available for delivery, is only 242 million ounces as of December 24th. And that's not the full story. Much of the registered inventory is already committed. It's allocated to commercial users through forward contracts. It's pledged as collateral for loans. It's held by ETFs like SLV that need to maintain backing for their shares. It's leased out to industrial fabricators. The amount of registered inventory that's truly available for spot delivery to anyone who stands for contract delivery is estimated to be only 40 to 60 million ounces. That's the float. That's the buffer that keeps COMEX functioning when delivery requests come in. And that float is being drained at 1.3 million ounces per day. At this rate, the float disappears in 30 to 45 days. What happens when the next large trader stands for delivery of 5,000 contracts, which represents 25 million ounces, and COMEX doesn't have unencumbered metal to deliver? That's when force majeure gets declared. That's when cash settlement gets imposed. That's when the exchange admits it can't fulfill its core function of physical delivery. And that's when COMEX loses credibility as a price setter for physical silver. The March 2026 delivery test. Here's the timeline that matters. March 2026 is a major delivery month for COMEX silver futures. December, March, May, July, and September are the active months where delivery volume is highest. As of December 25th, open interest in March 2026 silver futures is 68,000 contracts. That represents 340 million ounces of notional silver exposure. Now, 98% of those contracts will roll forward or cash settle before delivery, but 2% historically stand for delivery. 2% of 340 million ounces is 6.8 million ounces. In a normal market, COMEX can handle that delivery volume without stress, but we're not in a normal market. Registered inventory is declining rapidly. Refineries are offline. Industrial users are competing for physical metal. All three options are bad. But the worst option is doing nothing and defaulting on delivery obligations, which would trigger legal chaos and regulatory intervention. March 2026 is the stress test. If COMEX gets through March delivery without incident, the system survives another quarter. If delivery problems emerge, that's when Shanghai premiums explode to $20 or $30, and COMEX effectively stops functioning as a physical delivery market. The silver ETF problem. This COMEX stress connects directly to silver ETFs. SLV, the largest silver ETF, holds approximately 540 million ounces of silver. That metal sits in COMEX-approved warehouses and is part of the eligible inventory count. But SLV shares represent claims on that silver. If institutional holders redeem SLV shares and request physical delivery, SLV has to provide the metal. Those redemptions reduce the eligible inventory available to be registered for COMEX delivery. In November and December, SLV saw net redemptions of 34 million ounces. That's metal leaving the COMEX warehouse system entirely. Some of it went to industrial users who couldn't source silver through normal channels. Some went to private vaults for investors who want allocated storage outside the COMEX system. We could reach a point where SLV itself faces delivery constraints and has to suspend redemptions or force cash settlement. If that happens, the largest silver ETF admits it can't deliver physical metal to investors who thought they owned silver. That would trigger a crisis of confidence across all paper silver instruments. The endgame scenario. Let me paint the picture of how this ends. Shanghai premiums continue widening. COMEX inventory continues falling. March delivery month arrives with insufficient float to meet requests. COMEX either imposes emergency restrictions or faces delivery failures. At that point, price discovery shifts entirely to physical markets. Shanghai, Dubai, Singapore, and Zurich become the venues where real silver prices are determined. COMEX futures become a financial derivative loosely correlated to physical prices but no longer controlling them. Industrial users stop referencing COMEX pricing and start using Shanghai pricing plus freight as their benchmark. Miners negotiate sales based on physical market prices, not paper market prices. And investors holding physical metal realize their metal is worth significantly more than COMEX quotes suggest. This is the two-tier market scenario, paper silver at one price, physical silver at another. and the gap between them is the cost of settlement risk and delivery uncertainty in the paper system. We're not there yet, but the $12 Shanghai gap is showing us we're on that path, and the trajectory is accelerating, not stabilizing. The Shanghai premium isn't just about financial arbitrage failing, it's about industrial users in China paying whatever it takes to secure physical silver because their factories depend on it. Let me show you the demand-side pressure that's driving Shanghai prices higher. The solar manufacturing crisis. China produces 85% of the world's solar panels. The top manufacturers, LONGi, Trina, Jinko Solar, Canadian Solar, JA Solar, and Risen Energy, collectively produced 520 gigawatts of solar capacity in 2024. Each gigawatt requires approximately 310,000 ounces of silver in the form of silver paste for photovoltaic cells. That's 161 million ounces of annual silver demand just from Chinese solar manufacturers. And that demand is growing. Projected 2025 production is 630 gigawatts, which requires 195 million ounces. But here's the crisis. Solar manufacturers operate on thin margins. When silver supply becomes uncertain or delivery times extend, they face a choice. Shut down production lines and miss delivery commitments to customers, or pay premiums to secure silver and keep factories running. They're choosing to pay premiums. Reports from Shanghai silver dealers indicate that LONGi signed a 6-month forward purchase contract in November, locking 12.4 million ounces at an average price of $79. At the time they signed, spot COMEX was at $68.50. They paid a $10.50 premium to guarantee supply certainty. Trina followed with a similar contract for 8 million ounces at $77. Jinko Solar secured 6 million ounces at $78.50. These aren't small purchases. These are strategic inventory builds by companies that normally operate on 30 to 45-day silver inventories, but are now building 4 to 6-month reserves. Why the panic? Because in September and October, several solar manufacturers experienced production shutdowns when silver deliveries were delayed by refinery constraints. Those shutdowns cost them customer contracts and penalty payments. They've concluded that paying $10 to $12 premiums today is cheaper than risking production shutdowns that cost them hundreds of millions in lost revenue. This industrial hoarding is driving sustained demand in Shanghai that has nothing to do with investment speculation. These are real buyers who need real metal for real production, and they're willing to pay real premiums to get it. The EV battery pressure electric vehicles use 25 to 50 grams of silver per vehicle depending on battery configuration and electrical systems. China produced 14.8 million EVs in 2024, consuming approximately 36 million ounces of silver. Projected 2025 EV production in China is 19 million vehicles. That's 54 million ounces of silver demand, an increase of 18 million ounces year over year. EV manufacturers like BYD, NIO, and XPeng are also experiencing supply chain tightness. They're not building 6-month silver inventories like solar companies because EV assembly uses smaller quantities per unit. But they're paying elevated prices to ensure their silver paste and conductive component suppliers can deliver on schedule. This adds another demand layer to Shanghai buying. It's not one sector competing for silver, it's solar, EVs, electronics, and 5G infrastructure all bidding at the same time in the same market. The 5G build-out demand. China is deploying the world's most extensive 5G network. As of December 2025, they've installed 3.6 million 5G base stations and are projecting 5 million stations by the end of 2026. Each base station requires silver in antenna arrays, circuit boards, and frequency filters. Industry estimates suggest each 5G base station uses approximately 10 to 15 ounces of silver in various components. 1.4 million additional base stations in 2026 equals 14 to 21 million ounces of incremental demand. This 5G build-out is a government priority tied to industrial policy and technological competition with the United States. It's not demand that will disappear if prices rise. It's demand that will be met, regardless of cost, because it's strategic infrastructure. Add solar, EVs, and 5G together, and you have approximately 260 to 280 million ounces of annual industrial silver demand in China alone. That's more than China's total domestic mine production of 110 million ounces, plus their net imports of 150 million ounces. China is consuming every ounce of domestic production and every ounce they can import, and they're still short. That structural deficit is what's driving Shanghai premiums, and it's why those premiums keep widening despite appearing to create arbitrage opportunities. The strategic reserve accumulation beyond immediate industrial consumption. There's evidence that Chinese state entities are building strategic silver reserves similar to their strategic petroleum reserve and rare earth stockpiles. Customs data shows that China's net silver imports increased from 78 million ounces in 2022 to 124 million ounces in 2023 to 156 million ounces in 2024. For 2025, imports are projected to reach 180 million ounces, but consumption only explains part of that increase. Industrial demand grew by approximately 45 million ounces from 2022 to 2025. Investment demand from retail coin and bar buyers added another 15 million ounces. That accounts for 60 million ounces of the 102 million ounce increase in imports. Where's the other 42 million ounces going? The most logical explanation is strategic reserve accumulation by state entities or state-directed commercial enterprises. China learned from the 2020 COVID supply chain disruptions that dependence on foreign sources for critical materials creates vulnerability. They've spent the last 4 years building domestic reserves of semiconductors, rare earths, copper, and other strategic materials. Silver falls into that category because of its critical role in solar, EVs, and electronics manufacturing. If tensions with the United States escalate, or if Western countries restrict silver exports as part of sanctions or trade conflicts, China wants domestic reserves to buffer against supply cutoffs. This strategic accumulation isn't price sensitive. It's not demand that disappears when prices hit $85 or $90. It's demand that persists until reserve targets are met, regardless of cost. And that demand is layered on top of industrial consumption, creating sustained buying pressure in Shanghai. The feedback loop. Here's how these demand factors create a feedback loop that keeps widening the Shanghai premium. Industrial users pay premiums to secure supply. That drives Shanghai prices higher. Higher Shanghai prices attract more arbitrage attempts, but arbitrage can't execute because of delivery constraints. So Shanghai prices stay elevated, which makes industrial users more anxious about future supply. They respond by building even larger inventory reserves, which increases demand further. That pushes Shanghai prices higher again, and the cycle repeats. This feedback loop doesn't stabilize until either supply increases dramatically, which can't happen with refineries offline, or demand gets destroyed by prices rising so high that industrial users reduce consumption or substitute other materials. But substitution takes 12 to 18 months of engineering work. It's not a near-term solution. So the feedback loop continues, and Shanghai premiums keep widening. We're approaching an inflection point where COMEX either acknowledges it can't maintain current pricing, or the system forces acknowledgement through delivery failures. Let me walk through what happens in that scenario and what it means for anyone holding silver or considering positions. The March delivery moment of truth. March 2026 delivery period begins on February 25th, 4 weeks from now. That's when we'll know if COMEX can handle delivery pressure or if the system buckles. If delivery requests exceed available float and COMEX can't source additional physical metal, several things happen simultaneously. First, the exchange will likely raise margin requirements sharply to discourage new longs and force some existing longs to liquidate. This is what happened during the 1980 Hunt Brothers squeeze when COMEX raised margins from $10,000 per contract to $75,000 in a matter of weeks. Second, they may implement or tighten position limits, restricting how many contracts a single entity can hold. This prevents large players from cornering deliverable supply. Third, they may change delivery rules, potentially requiring cash settlement above certain thresholds or modifying which warehouse locations can fulfill delivery obligations. These rule changes, if they happen, will be announced as emergency measures to protect market integrity. But what they actually represent is an admission that the exchange can't fulfill its core function of physical delivery at the stated price. When that admission comes, watch how fast Shanghai premiums widen. If COMEX essentially tells the market you can't reliably get physical delivery at futures prices, then the entire paper pricing structure loses credibility. The price discovery shift. Once COMEX credibility fractures, price discovery shifts to physical markets. Shanghai becomes the primary reference price for Asian buyers. The Dubai Gold and Commodities Exchange becomes relevant for Middle Eastern trade. The Singapore Mercantile Exchange gains importance, and potentially Zurich or London physical markets become the Western reference. This creates a fragmented global pricing structure instead of the unified COMEX-centric system we've had for 50 years. Different regional physical markets trade at different prices based on local supply, local demand, and regional logistics. Arbitrage still exists but operates within constraints of shipping capacity, customs regulations, and delivery timelines. In this fragmented system, paper and physical diverge permanently. COMEX futures continue trading as a financial instrument loosely correlated to silver, but not determining physical prices. It becomes similar to how lumber futures don't dictate actual construction material costs, or how agricultural futures often diverge from what farmers actually receive for their crops. Physical silver holders benefit in this scenario because their metal trades at physical market prices, not paper market prices. The premium they receive is the delivery certainty premium. Someone who needs actual silver pays physical market prices. Someone who just wants price exposure can buy paper at a discount. The investment implications. For investors, the Shanghai premium widening to $12 and potentially $15 to $20 by March creates several strategic considerations. If you own physical silver coins, bars, or allocated vault storage, you're positioned to benefit from the physical premium. Your metal is worth whatever physical buyers will pay, not what COMEX quotes. In a scenario where premiums hit $20 and COMEX is at $75, your physical metal is worth $95. If you own paper silver through ETFs like SLV or through unallocated bank accounts, you have counterparty risk. If those institutions face delivery constraints, they may force cash settlement at COMEX prices while physical trades at significant premiums. You'd receive $75 when physical is worth $95. If you're considering entering a position, the question is whether you want price exposure or physical metal. Paper is cheaper up front but carries settlement risk. Physical costs more due to premiums but gives you certainty of ownership without counterparty risk. For industrial users and commercial buyers, the message is clear. If you need physical silver for production, you cannot wait for COMEX prices to normalize or for Shanghai premiums to compress. The supply chain is broken. Delivery times are 12 to 20 weeks. Premiums are $12 to $15 and rising. The correct decision is to secure supply now at current elevated prices rather than risk production shutdowns later when premiums are $25 or metal isn't available at any price. The timeline here are the key dates to watch over the next 12 weeks. February 25th, when March delivery notices begin on COMEX. Watch open interest and delivery requests. If delivery requests exceed 5% of open interest instead of the normal 2%, that's stress. If they exceed 10%, that's potential crisis. March 15th, when most March deliveries should be completed. Watch whether COMEX registered inventory remains above 200 million ounces or falls below. Below 200 million with another major delivery month in May creates critical stress. April 1st, when we'll have full data on how March delivery month resolved. Did COMEX change rules? Did delivery failures occur? Did premiums in Shanghai widen further during the stress period? And May 2026, the next major delivery month, which will determine if March was an isolated stress event or the beginning of systemic breakdown. The three outcomes. Scenario 1, COMEX survives March delivery and registered inventory stabilizes above 180 million ounces. Refineries return to operation in April and May. Supply pressure eases. Shanghai premiums compress back to $5 to $8 by June. This is the soft landing. Probability 30%. Scenario 2, COMEX faces stress during March delivery but muddles through with emergency measures short of force majeure. Inventory falls to 150 million but doesn't collapse. Shanghai premiums widen to $15 to $18. The system is wounded but functional. Two-tier pricing emerges but isn't catastrophic. Probability 50%. Scenario 3, COMEX can't meet March delivery requests without rule changes that effectively admit delivery failure. Force majeure gets declared or cash settlement gets imposed. Shanghai premiums explode to $25 to $35. Physical and paper markets detach completely. This is system break. Probability 20%. All three scenarios are bullish for physical silver holders. Even the soft landing scenario involves COMEX prices rising to meet Shanghai prices, which means $70 silver becomes $80 to $85 silver. The question is whether that happens gradually or through a crisis-driven spike. Based on current trajectories, current inventory drain rates, current refinery constraints, and current Shanghai premium widening, the probability-weighted outcome is COMEX prices rise to $85 to $95 by mid-2026, premiums widen to $8 to $12 in the soft landing scenario, or $15 to $25 in the stress scenario, and physical silver holders see 20 to 40% gains on metal they're holding regardless of which specific path unfolds. Shanghai silver at $82 while COMEX trades at $70 isn't a temporary anomaly. It's a systemic break in the 50-year paper pricing structure that's controlled silver markets since the end of the Bretton Woods gold standard. The $12 gap exists because arbitrage can't function when refineries are offline and delivery infrastructure is constrained. It's widening because industrial demand in China is driven by solar manufacturing, EV production, and 5G build-outs that need physical metal regardless of price. And it's accelerating because COMEX registered inventory is draining at 1.3 million ounces per day toward critical levels that will be reached by March or April. This is the stress test for paper silver markets. March delivery month will reveal whether COMEX can maintain its role as price setter or whether that role shifts to Shanghai and other physical markets. For 50 years, COMEX told the world what silver was worth. Now Shanghai is telling COMEX that paper pricing no longer represents physical reality. The $12 gap is the measurement of how far paper has detached from physical. And that gap is widening every week. The system is breaking. The timeline is March 2026. And physical silver is trading at a reality that paper markets haven't acknowledged yet. But they will. Because when COMEX can't deliver, the price they quote stops mattering.